My name is Jake, welcome to the channel. In today's video, I want to talk about investing into dividend aristocrats. If you're like me, I love investing into companies, businesses that are growing their dividend. I love investing into companies that are not at risk of their dividend getting cut. If you're a dividend investor and you plan on living off of the dividend income, the passive income, the cash flow from the dividend from your investments, it's really important that that dividend is predictable, that it's sustainable, and that it's safe. There's really no wonder that since the beginning of this year, there's been an uptick in interest in dividend investing. Usually when the market is just booming, everything is green, everything is going up, people really only think about investing into growth stocks, or they're really only concerned about growth. And then once you see a market pullback, as we've seen here this year to date, there's been a lot of ups and downs in the market. And a lot of those areas in the market that were booming last year and the year before have been hit pretty hard. And this is kind of what we call, a market cycle. The market goes up, the market goes down. And when you see market volatility go up and you see all of this chaos in the market, I think it's very normal for just your normal person to reassess and think about, okay, where they stand on the risk spectrum when it comes to their investments. So in this video, I'm going to share with you two ways that you can invest into dividend aristocrats. The first way is going to be super easy. It's going to be just through an ETF. The second way is I'm going to walk you through how to screen for dividend aristocrats. I'm going to show you the things that I think about when I'm looking at dividend aristocrats and the research that I initially did when I was first putting together my portfolio. So the first half of this video is going to be straightforward. If you want a one size fits all, hey, just show me the easiest way. That's what I'm going to do for the first part of the video. The second half of the video, I'm going to walk you through step by step some things that you can do. You can follow along in this video when looking at dividend aristocrats and some of the things that I personally look for when I'm screening for different companies that I may want to be interested in investing in. So regardless of your experience with investing, I think this video is going to be a little bit more skewed towards newer investors that are looking or thinking about building a dividend portfolio. And this is going to help you understand and how to understand that all dividend aristocrats, they're not all created equal. And I'm going to show you why in a minute. So if you've been following my channel for the last couple of years, you've seen my portfolio go up and down. I dollar cost average into my portfolio. A couple of months ago, has it been a couple of months? It feels like a couple of months. Towards the end of March, I sold a rental property and I invested $300,000 into my portfolio. And ever since then, the market has been going crazy. It's up one day, it's down one day. If I look at the last month here, look at this. This is like insane. Like, when you only have like $5,000 or $10,000 invested, which can be a lot of money. I don't want to, it's all relative. The amount of money that you have invested is relevant to you. But like when I think back, a couple of years ago, when I only had a couple $1,000s invested, when the portfolio would go down 20% or 10%, I wouldn't really care because it wasn't really a lot of money for me. But now, fast forward a couple of years ago, where I'm just like, holy cow, I'm down $30,000 in 1 week. And then the next week, I'm up $31,000. It's just like the emotions. I can understand now even more that, how investing can be emotional. This year has been really weird. There's been a lot of ups and downs throughout the year. And all I can say is it's been a crazy time to be investing. And if you've been investing in 2022, it's felt a little bit like this.
My dog stepped on a bee.
You turned her against me!
My yard's full of debris.
My child spilled my tea.
Where's Harvey? I really need to pee. I want to break free!
Oh my gosh, I gotta get that on DVD. Oh, facepalm. All right, cool. So in today's video, let's first talk about the easiest way to invest into the dividend aristocrats. So first off, if you're ultra new and you don't really know what a dividend aristocrat is, a dividend aristocrat is a company that has increased its dividend consecutively for the last 25 years. This is really a prestigious status that a company can reach. And you better believe it, that the companies that reach this status of dividend aristocrat, this is a very sought after status. If a business has been able to increase their dividend for the last 25 years plus, this says something about their business model, their management team. It says something about the economics, the competitive advantage. There's so many great things going well for this business. If it, in most cases, if this business is able to increase its dividend consecutively for 25 years plus. So the very first way, the easiest way that you can exposure and invest into the dividend aristocrats is to invest into an ETF like Noble. Noble is from ProShares. This ETF gives you instant access to all 65 dividend aristocrats. But the thing that's interesting about this ETF is it's equally weighted. A lot of ETFs are market cap weighted. So that means the largest companies get the most exposure or the highest weighting. With this ETF, it's a little bit different because all of the companies, for the most part, are fairly equally weighted. So what that means is you get equal distribution or equal weighting in, for example, Linda or, I don't know, Consolidated Edison, as you would, for example, with Pepsi, AbbVie, or, for example, Ecolab. That's the thing that I absolutely love about this ETF. So at face value, I actually am a big fan of Noble. I personally do not invest in a Noble. They have a fairly high expense ratio. They have good assets under management. They've been around for a while, but I just personally, in my current situation, because I don't have millions and millions of dollars to just throw in this fund, and I'm more skewed towards growth, I personally prefer an ETF like SCHD, which focuses on dividend growth, yes, but it's mostly focused on companies, businesses that have grown for they paid a dividend for at least the last 10 years, but they have different screeners. For example, the cash flow to debt ratio for the business, the return on equity, the dividend yield, the dividend growth rate, etc. Another good dividend ETF is DGRO. The difference with DGRO, though, is they're only looking at companies that have increased their dividend for at least 5 years. So there's a lot of businesses in here that cut their dividend during the financial crisis and so forth. So the quality aspect, Noble is really the cream of the crop when it comes to dividend companies. So that's the very first way. If you want to invest into the dividend aristocrats and you just want to set it and forget it, Noble can be a great way to get instant exposure to that part of the market. If you want only to focus on quality, maybe you're an investor that is scared. You're very emotional and hey, I don't want to invest into the stock market because I don't want to lose everything, or I don't necessarily understand the ins and out of what I'm doing. This is a great place to start. If you're a brand new investor and you're thinking about getting into the stock market and you're on the fence, this is a great way to get off the fence and to start investing into the stock market. This is one of the best, highest quality ETFs out there when it comes to the companies that are held in the vehicle, the index fund here, the ETF. Another example would be if you know somebody, maybe a family member or a friend who is maybe on the fence, is a little bit hesitant to get investing into the stock market, maybe start with an ETF like this. Noble, you're not going to get as much fluctuation up and, upswings, downswings like you would with the S&P 500. So the beta is a little bit lower when it comes to Noble. So if you have a family member or a friend, this may be a good starting point for them to start getting experience with investing into the market, maybe set them up or help them, learn about dollar cost averaging and starting with an investment like Noble if they want to focus on a dividend growth strategy. All right, now let's talk about the second way of how you can invest into the dividend aristocrats. Now, like many of you watching and following the channel, this is how I started out. When I first started learning about dividend investing, I watched videos years and years ago from PPC Ian, really, informational content around dividend investing. I was researching, reading blogs, watching videos, everything that I could when I first started learning about dividend investing. And this is one of the very first sites that I landed on when I was learning about dividend investing. Sure Dividend has great free content when it comes to the dividend aristocrats. A lot of their content is centered around the dividend aristocrats and the dividend kings. And they keep this list, the Dividend Aristocrat list, up to date. And if you want to go to shareddividend.com, I'm not affiliated with them. I just find their free content very valuable to your do-it-yourself investor like myself. But they have the list of Dividend Aristocrats in an Excel file. And the reason why this is so great is because if you're a new investor and you're looking and doing research, you have the Excel file right there at your fingertips. And so on this website here, you can go in, you can type in your email address and say, yes, send me the spreadsheet now. And then you can click on the link here and you can click and download their Excel spreadsheet. And so I want to kind of walk you through some of the things that I think about as a dividend investor and share with you some things that you can do as well. So if you want to download and pull up this spreadsheet, you can pause the video and we can kind of walk through this together, and I can kind of walk you through how I view this as well. So some of the things that you can do, let's say, for example, you're building out your portfolio and you want to find companies that are in a specific sector. Let's say, for example, you have a ton of consumer staples, but you want a few, healthcare companies. What you can do is you can filter by the different sectors in the market, and you can see, okay, where do I want to focus on getting more exposure if you, for example, have too many staples or defensives or whatever. So this is a great way to filter and do your research on the different dividend aristocrats that are out there. The next thing that I like to do is so in terms of full disclosure, a couple of years ago, four or so years ago, when I first started learning about dividend investing, the very first thing that I would do, and I'm sure there's a ton of you out there that are the same way, the first thing that I would do was, all right, let me filter by the highest dividend yield, and that means that this is the company that I need to invest in. All right, all of these companies, 4% and above, all right, I'm going to go and now automatically invest into IBM, Leggett & Platt, Walgreens, Realty Income, Franklin Resources, 3M, and VF Corp. That is how I first started. And I think the majority of people that are going on YouTube and researching dividend investing, they probably started out that way as well. And there's nothing wrong with that. It's just a matter of educating yourself and understanding that, well, there's a little bit more than just the dividend yield itself, okay? So if, for example, your dividend yield and you're building out your portfolio, let's say it's too low, right? Let's say you have a 2% dividend yield, but you need to bring that average up to 3%. Well, what you could do is you could say, all right, well, I'm going to then focus on companies that have maybe a higher starting yield today. Now, the use case here is very, very important. If you need the dividend now, well, then yeah, that makes absolute sense. I'm going to focus on those companies that have a higher starting yield, but are growing their dividend significantly slower. Okay, so here's the key thing. Make sure you're paying attention to this. A lot of the companies, depending on your time horizon, it really depends on what your time horizon is that you should be focusing on which companies you should be investing in. Let me give you an example. Let's say here we looked at Leggett & Platt here, for example. Leggett & Platt, they just barely increased their dividend here by, I think by like 5%. Let me check. Leggett & Platt, exactly. They just raised their dividend by 5%. So to 44 cents per share. Leggett & Platt has a really strong dividend yield today. So if you think about it, if you have a short-term time horizon, meaning you want to live off of your dividend portfolio sooner than later, this is a great option to look into. However, if you have a long-term time horizon, let's say you have 20 plus years and you want to focus, and if that's the case, you want to focus more on these down here, but these type of dividend aristocrats, those that have a lower starting yield, but are growing their dividend significantly faster. Let me give you an example. Let's take a look at Lowe's. Lowe's just increased its dividend by a significant amount, but you see here that it has a starting dividend yield of just over 2%, a 2% dividend yield. Lowe's just raised its dividend by 31%. Holy cow, 31%. Imagine you're working at your day job. Are you getting a 31% raise year over year? Yeah, I didn't think so. That is absolutely insane. This is the power of dividend growth investing. You see this? Lowe's just increased its dividend by 31%. But you know what the really, really cool thing is? Last year, they increased their dividend by over 30% as well. Isn't that amazing? Now, I highly, highly doubt that they're going to go 3 for 3. I don't think they're going to raise their dividend by 30% next year, but it just speaks volumes to the power of the growth and the compounding that comes with a long-term time horizon. So when I made that comment about all dividend aristocrats are not created equal, they're not, right? And so if you have a long-term time horizon, it is by far the better choice, in my opinion, to focus on a company that is growing its dividend significantly faster. In 20 years, you're going to far, far surpass the dividend, the yield on cost with these companies up here if the dividend is growing 10+%, etc. So that is the key thing. That's why I talk about time horizon so much on my channel, because your time horizon dictates everything. It's so important. It's by far more important than anything else. It's when you plan on living off of the dividend income from your portfolio. Okay, so that's the dividend yield piece. Let's take a look. We already looked at this here, the years of dividend increases. Isn't this amazing? There's over what? Let me see if I can see that. There's 24 dividend kings. Next year, there's going to be 3 more. Isn't that amazing? These companies right here, it's not just a fluke that these companies were able to increase their dividend for 50 plus years. These are phenomenal businesses with phenomenal moats. It's just absolutely incredible. Okay, so let's take a look at this piece right here. This is probably my second favorite part of this sheet, is the dividend growth. So the dividend growth, this is often referred to, if you use Seeking Alpha, this is the dividend compounding annual growth rate, CAGR, right? This is how quickly a company is growing its dividend. And this is annualized. So what that means is it takes the 5 years and it averages them out. And that is why, that is the number that you're seeing here. So with AbbVie has grown its dividend by 17% over the last 5 years. I don't think that this is going to continue, but it's absolutely remarkable. All of those investors who've been investing into AbbVie for the last 5 years, they've enjoyed a 17% pay raise every single year. T. Rowe is also a unicorn. T. Rowe has increased its dividend remarkably. It's absolutely amazing. Another one that I find so interesting right now is A.O. Smith. So if you watch CNBC, I really like listening to Josh Brown. I also watch the Compound Show every single week. I love their podcast. I just love I love how uncensored they are. I think they're great. A.O. Smith is one of Josh Brown's favorite new stocks, at least here this year. They have an incredible business model. I think if you're interested in investing into stable businesses and you're interested in researching stocks, this is a company that you might be interested in researching. A really, really great company. So it's not the most exciting. They don't sell, technology, right? They're not like a technology company. They're not a flashy, tech software company. It's a pretty standard, old school industrial business here in the United States. Really interesting. So for example, if you're just starting out learning about dividend investing, once you know your time horizon, say it's 5 years, 10 years, 20 years, 40 years, this is really the thing that you want to focus on, is this right here. You want to focus on getting this piece right. This is probably the most important part when it comes. It's kind of, I can't really say it's the most important part because this part is equally as important, but these two, E and G right here, very, very important areas that you need to make sure that you're understanding and you're getting right if you choose to invest into individual companies. The next thing here that's really important, at least it was for me when I was first learning about dividend investing, is I wanted to invest into companies, businesses that were a little bit more established, right? I don't want to invest into a company that's going to get delisted or go under. They're small and, some incumbent comes and takes them over, right? And so this was something that was important to me, making sure that I was not investing into businesses that were just going to fade away. right? Now, the likelihood that if a company is on this list, they're not going to likely just fade away, okay? So, but anything is possible. So let's take a look at this next one here, the trailing PE. So the PE ratio is really important because this is kind of how you view how expensive a company is at any given time. Now the PE, you can't always take the PE for certain businesses like realty income. You don't look at PE when it comes to REITs. REITs, you look at funds from operations. You don't look at PE. So very, very important. You look at some of these companies, they have really, really high PEs. Now, what you have to also understand is this is the cream of the crop of the market. These are the best run businesses in the market, okay? And so they're going to demand a higher valuation. And that's what this column is right here. This is the valuation. How expensive is the cash flow that this company is generating? How much do you have to pay to get access to that cash flow as an investor? Okay, you look at the example of Coca-Cola. Coca-Cola has always, ever since Warren Buffett has got involved with the business, it's what they call the Warren Buffett effect. Coca-Cola has always been traded at a premium, at least relative to Pepsi, for example, because of Warren Buffett owns or is a shareholder of Coca-Cola. Okay, so that's important that you understand that. The payout ratio is the next thing that I want to talk about. The payout ratio is important because this is the risk factor, how risky an investment is. The lower the payout ratio, the more likely the company is going to be able to grow their dividend over time. Now, it's not always the case, but in a lot of cases, you want to have a healthy payout ratio in every industry. This is important. This is not black and white across all industries. Every industry has their own norms. For example, utility companies, sin stocks, those kind of companies, they trade typically with a higher payout ratio. And that's very normal, right? However, technology companies or growth companies, you want to see a lower payout ratio, right? So it's very important. Don't just look at the payout ratio and disregard a company because of, they have a 56 payout ratio. Is that normal? Well, for Illinois Toolworks, it's actually fairly normal to have a payout ratio in the 50s. Okay, really, really important. The last thing that I would say, I guess, is, beta here. Beta is the volatility index or a way of measuring volatility. The lower the number here, so 1 would represent the S&P 500. So 1 equals market volatility, right? You see this, S&P 500 go up and down every day. That's a beta of 1. If a company has a beta higher than 1, that means they are more volatile than the S&P 500. If a company has a lower beta than 1, that means they're less volatile than the S&P 500. And that example that I shared earlier with, those that are new to investing or maybe on the fence with, when it comes to investing, this is a great way to start because you're going to, start with companies with a lower beta because you're going to have less volatility, less ups and down swings in the price. So the great thing about using an Excel sheet similar to this is once you've filtered all of the different things, you've looked at the different metrics that are important to you, right? Everyone watching this video is in a different situation. Everyone is different, right? Everyone has a different time horizon. Everyone has different risk tolerance, all of that. Once you've found, the different companies that you're interested in based off of the different metrics, right? Whether it's dividend yield, whether it's dividend growth, whether it's, the PE, the payout ratio, the beta, whatever it is, or the sector, then what you do is you go to another website like Seeking Alpha. Seeking Alpha is just in my opinion, the best website when it comes to researching and finding information about a company. And the best thing about it is your normal person can do it. And so what I like to do is once I have the company pulled up, I like going to the dividends tab and I like looking at the history, right? How long have they increased their dividend? How long have they been paying a dividend period? What I also like to do is this is the thing that I like to do, especially when I'm looking at new companies. I like to go back and look at what were they paying in 2005, 2006, 2007. And here's the thing. I want to see what did they do with their dividend in 2008, in 2009. Because as many of you know, during the financial crisis, a lot of companies cut their dividend. And during the financial crisis, there was dozens of companies that were on their path to being dividend aristocrats, but they're no longer on that path because they cut their dividend in 2008, 2009. And so when I research dividend companies, I love looking at what they did during this time period. Now, in more recent history, right, you can look at what a company did in 2020. Did a company grow or cut its dividend during the pandemic? That is something that I, as a dividend investor, I love looking at that. When I look at for a company, I look for those things. And what I also like doing is I like looking at under the dividend growth. And when I look at the dividend growth, I generally like looking at the 10-year CAGR. The 10-year CAGR it's just more data, and I love data. And if I can make a decision based off of data, not only what my gut tells me, it makes me feel really good about my decision. And so when I look at the dividend growth rate, the CAGR here, I like looking at the 10-year, and you can see that Lowe's has a dividend growth rate of 19%. Absolutely incredible. How many of you watching get a pay raise of 19% every single year? Now, exclude the pandemic, right? How many of you got a 19% dividend raise, over the last 10 years? Every single year, annualized. Absolutely incredible, right? And so these are the kind of things that I'm doing when I'm researching dividend stocks. And I think, if just your average person can do the exact same thing, I really like, so here, let me show you this really quick. So you got dividend yield. I do this all the time. So the first thing is I like looking at the 4-year average dividend yield. The 4-year average dividend yield on Lowe's is 1.6%. All right. Now, this is not updated because they haven't updated it with the dividend increase, but the current dividend yield is over 2%. So that means if you're investing into Lowe's today, you're actually getting a higher starting forward dividend yield than the average over the last four years. I think that's incredible. For all of you value investors out there, that is absolutely huge. This is something that we love to see as value investors. Okay, and so the yield on cost, another thing that's pretty cool, you can see, okay, what would have my dividend been, had I invested $1,000 back in 2017? The initial investment of $1,000 back in 2017 would have been over 5%. So these are the kind of things that I'm doing when I'm researching dividend stocks, especially the dividend aristocrats. You'll go check by check, and there's just so many great things that you'll find as a dividend investor as you're learning about these businesses, about these companies. And what you'll notice is that not every dividend aristocrat is created equal. As we mentioned, not every dividend aristocrat is right for every investor. So you really have to do your due diligence and understand, okay, is this business the right investment for me given my time horizon? Thank you so much for watching, everybody. I hope that this video was helpful. I hope that you learned something new. Like many of you, this is the exact same thing that I did when I was first learning about dividend investing. I did a quick Google search, dividend investing, dividend aristocrat. What is a dividend aristocrat? The beautiful thing about dividend investing is, especially if you're brand new to investing, this is such an amazing feeling. Once you find that passion for dividend investing, it really opens your eyes to, a whole different light of investing. And like many of you, there's a lot of stress and a lot of things going on in the world. I'm just so grateful that I've, come across this concept of dividend investing, because investing for me used to cause a lot of anxiety. Now that I've really focused on dividend investing, it makes me happy. It makes me excited that, I'm on this path and I know what my goal is. I know what my time horizon is. And it's just making the math work for my wife and I so that we can ultimately reach financial independence and reach FIRE. Thank you so much for watching. I'll catch everybody in next week's video.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.